Welcome back to the channel. I'm Jacob Fisher, and today we're talking penny stocks. There are a couple definitions of penny stocks, but they are all related to stocks that are less than $5. These are the stocks that you see that are up 20, 50, 100, 300% or more in a single day because of some news article they put out saying that they cured cancer or that they turned their cameras into Bitcoin mining machines. Kodak. We're going to get into that example in a little bit, but first let's tap that like button and subscribe if you like content like this. Let's actually first define the two kind of main types of penny stocks. There's the OG ones from the Wolf of Wall Street, the pink sheets, the stocks that trade on the OTC or over-the-counter stock market, which many are worth pennies on the dollar, sometimes sub-pennies. You can find stocks that are worth 0.001, and you can buy millions of shares of the company with $1,000 in hopes that if it hits $1, then you will become a millionaire with your million shares. There are also other kinds of small cap stocks that are mostly on the NASDAQ or that, newfangled tech stock exchange that most stocks trade on. There can be microcap, but think companies with less than 2 billion in market cap to define that small cap for the other category. These small caps are going to be the focus of the video because while OTC stocks are in fact penny stocks, you can't buy them on Robinhood and they are much riskier, and some brokers still charge a fee to actually buy the stocks. We're also going to have to real quick touch on the fact that 90% of traders don't need to use a professional broker to trade small caps. The ones that charge commissions, because 90% of traders are still learning how to trade, and you don't need to lose money on top of the commissions, so you don't need to lose money twice because of that, right? Then once you figure out how to trade and you're actually profitable, you can consider a professional broker for pristine trade executions. Speaking of brokers, and this applies to everybody, unless you have $25,000 in your portfolio, then you'll fall under the pattern day trading rule. So if you make more than 3 round-trip trades in a rolling 5-day period, you will be restricted in your margin account. If you make 3 trades on Monday, then make another one on Tuesday, your account will be restricted for 90 days because of the pattern day trading rule. It's not the broker's fault. It's the government's for this rule to protect the average investor, which arguably doesn't, but that's another video. Let's do a quick scan on Thinkorswim to actually figure out how to find these stocks, because how do you know, what do you do? So Thinkorswim is a free platform by TD Ameritrade, by the way. You should definitely check it out. Anyways, I set the scanner to stocks between $1 and $20 and that have traded 150 shares and are up 4% on the day. Generally, you can run a scanner like this in the morning to find all the small caps or penny stocks active on the day. You can continue to scan throughout the day to find new ones. Now, there are a million ways to trade these companies. You could trade when it breaks the pre-market high, trade it around that VWAP, short the stocks for when they go down, or buy when the stock collapses too quickly and then get in for a small rebound. A million ways, but all viable ways to trade penny stocks. One thing you notice about penny stocks is that they always seem to come back, and most of the time they are incredibly volatile because of the float of the stock. We mentioned float in the GameStop video, but it's essentially all the available shares the public can trade. Apple has tens of billions, while a company like Check has tens of millions, and some others have a few 100,000. That means somebody could buy 200,000 shares of a company with a 1 million share float and drastically affect the price of the stock. But if you purchase 200 shares of Apple, then the stock's not really gonna move all too much. This is one of the reasons that they can become incredibly volatile and move 100% or more, or not less, in a single day. Let's take a look at Check on the chart, and you'll notice that there are already lines on it. That just means that years ago, when I wanted to trade penny stocks because that was way more interesting than investing in Apple for 40 years, I saw Check, or CHEK, on my scanner and may have tried to trade it based off the support and resistant lines. Funny how some of those lines still match up on the chart today, but that could be because there are a ton of people still bag holding from years ago. Why are they up though? Well, according to the news, they've released the FDA IDE approval for a pivotal, absolutely groundbreaking study of C-SCAN. That doesn't mean their product is approved, oh no. Their product was approved for testing, the early stages, but wait, there's more. I thought they had applied for this study back in 2018 when they got conditional approval to start the study. Well, that did happen, and they also had positive results back in 2019. Just amazing. right? So why did they do another study on the same system? Who knows, because I certainly don't. This isn't to single out check because maybe they have a product that will actually work from 3 years ago. It's more of an example of what you can find with every single penny stock out there. 90% of penny stocks, maybe even closer to 100, are just scams benefiting by releasing positive press articles to generate hype so that they in turn can do an offering to raise money or for insiders to sell their stock at a higher price than what it was purchased for. Let's take a look at Kodak, the camera company that wanted to get into Bitcoin and more. Most recently, they had a spike, I should say, because back in early 2020, they got approved for a $765 million loan to produce pharma ingredients. A camera company turned Bitcoin miner turned pharma company. I mean, you can really do anything now, right? The Bitcoin miner that I keep mentioning is the Kodak Cash miner. They announced back when Bitcoin was initially going crazy, which caused their stock to spike from $3.05 to $13.28, a hefty spike. But since they only have a 43 million share float, it all kind of makes sense. Turns out, Kodak never released that product. In fact, it was just scrapped, and they never actually got that $765 million loan because there was investigations and fraud and a whole bunch of other stuff, which is again a similar story for most small caps you discover. Sometimes there are companies out there that actually make it to market and have a good product and they become a successful company. But it's hard to find examples of them because it normally doesn't happen. Just because companies fail though doesn't mean you can't trade them, because you could trade them, you can't invest in them, because if you invest in them, you'll probably lose money. Most of the time you will. You can profit off the companies having large spikes because of the news that they put out. You want to find a stock to have some sort of support line on when you're looking at the chart, and then getting in when it, potentially breaks out after a resistance point, or you get stopped out because the stock actually went back down and broke support. So if you find a little base support level for it, you buy then, sell when it breaks the resistance from above. That's generally a very simple way to trade and kind of just a very broad strategy to go with it. But the most important detail out of that is that you have to sell when that stock breaks support. You don't hold on forever. You just have to accept the loss and move on to the next one, because every day there's 10, 20, 30. I mean, there's sometimes hundreds of different penny stocks that are up 40% on the day. If your plan that you put in place to trade stocks has the potential to make 20 cents per trade, then you can probably set your stop loss to be like 10 cents or so. That just means if you encounter 2 losses, you still actually are winning, because you only need 1 win to make up for that loss. That's a 33% win rate. But if your win rate is 60% or so, then you should be good as long as you are cutting losses and not taking huge losses because you think the stock will just go back up, even though it's broken support many times. Now you're down 50% on the trade. Even better is a 5-to-1 risk reward ratio, meaning your winners are the 5x or 5 times the size of your losers. You can lose a lot more in that situation, or more times in a row, and still have a couple good winners to cover all of those losses and more. You could also be a scalper and trade based on momentum, making 5 cents per trade, but making more trades per day, adding up to maybe a successful whole dollar that you made. You need a win rate of like 70% or more to actually make this strategy successful. Really, the important thing to remember is that penny stocks are 90% scams, and that they aren't something to invest into, but rather trade on a continually active basis. You can also lose a bunch of money with them by trading them too, so don't just keep taking losses if you can't find a good strategy that works for you. Let me know your thoughts on penny stocks in the comments below, and other things that I might have gotten wrong. I upload videos on Monday and Friday in travel and finance, so if that sounds like something interesting to you, hit that little subscribe button down there. Thank you so much for watching, and until next time.